Hello everybody, welcome back to my channel where we talk all things finance and investing. Today's video, I'm going to do a bit of a deeper dive into this whole thing about private markets, private investments. If you saw my video last week on how the top 1% like to invest their money, they were above 40% in private investments, or otherwise known as alternatives. And it looks like, from what we see in the press these days, that alternative investments and things like the private markets, private equity, is going to be more open up to investors. And that could be through your pension plan, like a self-invested personal pension or workplace pension, for example, or a 401k, for example, if you're in the US. So I thought it'd be worth doing a deeper dive because Hargreaves Lansdown, the largest platform for investments here in the UK, has just announced that they're opening up to retail investors to get access to the private market. So let's get into it in a bit more detail, get ourselves educated as we like to do on this channel, and learn more about private market investing. So before we get started, let's just do a quick recap of what public market investing is versus private market investing. Now, public markets are stuff you probably already know, and these are stocks and bonds that are already listed and they're available for you to invest in, typically nowadays with the click of a button. So the most obvious example of public market investing are public equities. And this is just owning shares, a shared ownership of a company the likes of Apple, Microsoft, many others here in the UK as well, that you can just buy on a stock exchange. It's very quick and easy to do. They're very, very liquid, meaning you can buy and sell really at any time that the market is open, and you'll always have a price, particularly for the larger companies, that you can trade at. So that's one of the key advantages, the liquidity of these. You'll always see the valuation of it. Now, private markets are investing in companies that aren't listed on a stock exchange, for example. So there are so many companies, particularly early stage growth companies, right? They're trying to get investors to invest into their business, and they're not really developed or grown to the point where they're ready to list their shares on a public stock exchange for you and I to invest in. So they will go and look for capital from private investors, things like private equity, to help fund them to get that business up and running and off the ground and get growing. And they will do that, and maybe at some point they'll list on the stock exchange, or maybe they will not. But those early seed investments, as they're known in private equity, they're the ones that put up the capital and have a say in the business and the growth plan and everything, and they would actually look to exit at some point in the future. Now, the disadvantage with this, as you can tell from my explanation here, is you can't just buy and sell like you would do on a stock exchange. So the private investors or private market investors are gonna have to invest the money and expect to hold it there for a long time. And that would be 5 years, maybe even more, before they could expect to see that money back. So private market investing, it's very illiquid. And that is considered one of the downsides to it, because you can't just access your cash if you need it very quickly. So when you think of private market investing, you can just think of some of the things I mentioned, like private equity and early stage companies, but it also includes things like, real estate or infrastructure, stuff like that, which you can imagine are big projects that take a long time to get off the ground. And maybe if you own your own property, a house, an apartment, flat, whatever the case may be, in a way, that's a private investment. You can't just sell it by the click of a mouse nowadays, right? So a lot of you would already have some exposure to a private type of asset like real estate, for example. But private markets now also offer their investments through funds. So a fund manager would go out, they would take the pool of assets from investors into the fund, and they would invest into early stage companies or in infrastructure, real estate, private credit, and they would do all the due diligence on these companies or on these projects and decide whether to invest or not. And of course, that's how people like you and I, retail investors nowadays, would get access to private market investments through funds. And that's what's going to be happening with Hargreaves Lansdown as they partnered up with Schroders and put these two funds available to retail investors, people like you and I, with some caveats. So the case for public market equities, of course, is they're just so transparent. You can look at the S&P 500 or the FTSE 100, and you can get an idea of the returns over the last 25, 50, even 100 years in some cases. And of course, the companies that make up those indices and on the stock exchanges, They report their earnings quarterly in the US, although that's up for some debate right now. But you can read their annual report and you can get a real deep dive into the business and get an idea of what's going on, how much money they're making. You get a full view on their financial statements, their accounts, their balance sheets. So transparency is super high. It's also very cheap because, of course, if you buy an exchange traded fund, for example, that trades on an exchange and tracks some of the main indices, you can do it for under 10 basis points, under 0.1%. So it's a very cheap way of investing. So cheap and transparency is a great benefit of investing in the public markets. And of course, you can do so with a couple of clicks on your phone or your mouse nowadays and get invested into the public markets when the stock exchange is open. So what about the case for private markets? Well, this could be a way to add diversification and allows you to get access to other markets and other sectors, for example, that you might have struggled to do so before. But there's also another case for it, and you can potentially get higher returns than you would do in the public markets. But of course, this is going to depend on the fund manager, the investments that get made by that fund manager in itself. But the potential for higher returns is there, but it should be there. Why? Because you're holding off your money, the illiquidity is there. So if you can't get your money exactly when you want it on the click of a mouse, then therefore you should be compensated by a higher return. Of course, higher returns also mean higher risk, and that is a key component to factor in private market investing as well. Think of it, early stage companies, so many fail, but the ones that hit it big are like winning a lottery ticket to a certain extent. They go off and they have valuations that multiply by many, many times over a short period of time. Of course, the key is trying to find those companies, and it's a very difficult thing to do. I mentioned fees a minute ago. When it comes to public market investing, you can get exchange traded funds that track the S&P 500 for 7 basis points, 0.07%, 10 basis points on others. But the point is these are extremely cheap ways to get access to the public markets. The private markets are different. They have higher fees attached to them. Fund manager fees, 1-2% easily to get invested in some of these funds that invest in private equity and infrastructure, real estate, and all of this sort of thing. And fees can absolutely wreak havoc on your returns. So that is a key detractor, in my opinion, when it comes to investing in private markets. And of course, when you compound those costs over the long term, you could have a very big difference on your actual final pot of money that you have in your retirement or your stocks and shares ISA account, for example. So of course, if the fees are higher, then you need to have a higher return. And because the transparency isn't as great in the private market funds and investing versus the public market, it can be difficult to really know what your returns are going to look like. I did find one article in Institutional Investor which basically said that private market returns over the last 25 years or so have averaged around 13 to 14% per year net of fees, and that's a key part, so that's after fees. If you compare that to something like the S&P 500, for example, where the average annual return is around 10%. So there's a pretty big difference there, 3 to 4% per year. And of course, you multiply that over, say, a 30-year horizon, the numbers would be very, very different, and you would have a much, much higher return if you invested in the private markets and had an additional 3-4% per year on average. Now, typically private market investors have been known to be pension funds or endowment funds, like some of the big universities, for example, in the US and things like that. Now, why is that? Because they're long-term investors. Pension funds are investing for 20, 30 years down the road. So they don't have any problems about tying up their money for a long time like that. But as an individual investor, someone like you and I, you never know when the cash call might come. If you're in your retirement and all of a sudden you need a chunk of money and you need to sell some of your assets down, of course, this could be a problem if you're invested in the private markets versus the public markets. But pension funds, endowment funds, things like that, they don't have to think about that at all. Okay, so now let's get into what's happening in the UK market, specifically Hargreaves Lansdown, and a couple of the funds that they're offering to some retail investors here in the UK. Now, I think one of the main motivations behind this, and we're seeing this in the US and in the UK as well, where governments are looking to open up pensions and 401ks to be able to invest in the private markets. And I think the answer as to why is pretty obvious, because they want to stimulate economic growth. And they know if they can get pension funds, 401ks, self-invested personal pensions, investing in early stage growth companies, then that's likely to have a good impact on company growth at early stages and of course economic growth overall. And that is a big challenge, particularly here in the UK, where economic growth has been a challenge for quite some time. We need to be able to find growth, and this could be a way that the UK government will do it. We've seen a lot of companies at a later stage, the stage where they're ready to list their shares on the market, choose the US as a place to list because they feel they're going to get a higher valuation. And the UK government is probably trying to tackle this by opening up pension funds to be able to invest into private companies. That's private pension funds, people like you and I. So I thought what we would do is just take a quick look at the paperwork, the website on Hargreaves Lansdown, and get an idea what these funds look like, the fees involved. And I'll give you my opinion at the end of that on whether or not I would invest in them based on what we see here. Okay, so on my screen, we just have the Hargreaves website and the landing page for their whole long-term asset funds, as they're known. Notice how they put long-term in there. They really want to get the message out to retail investors. If you're going to invest in these private market funds, it's long-term. And that's key point. I think they've done well to mention that. So reshaping private markets, long-term asset funds tailored for retail investors, diversification and growth opportunities away from public markets, and you can hold them in a SIP or normal fund and share account with Hargreaves Lansdown, just using their normal kind of online process. So that's the landing page there. Basically all the information, or the high level information, but the main thing here is you get exposure to alternative assets such as real estate, infrastructure, and private equity. And of course they've done this by teaming up with Schroders Capital, who've actually been the fund managers here to provide these funds through Hargreaves Lansdown. Of course, by buying these funds through Hargreaves Lansdown, in theory you're paying less in fees than you would do if you were going to Schroders directly. So you can have a look at this landing page here to get some more information. And of course, are they right for me? Well, here's a breakdown, and all the things I've just kind of discussed as outlined. They're high risk, they can be highly volatile, and of course your money is tied up for longer. In fact, these funds are priced only on a monthly basis, as we'll see later, okay? And there's redemption limits, and there's even the chance that you're refused your money if the fund manager decides not to allow a redemption at a certain point. But have a look at all of this stuff so you get a lot more information here. Notice at the top they've got a banner here explaining how it's a high risk investment. They may take a long time to buy and sell, and only invest if you can wait possibly several years to get your money back. You don't have any protection against poor performance as well. So yeah, have a look at the landing page for LTAFs on Hargreaves Lansdown. If you go to the fact sheet, so this is just the Hargreaves website, and the fact sheet for these particular funds, there's two funds, a global energy and a global private equity one. So this is the global equity fund. Here's the thing for me, if you look at this, there's very little information, in all honesty, because they're kind of new funds. All you really have, well, you don't have any of the performance data, and you have a little bit on the fees. So this global energy fund is actually got a net charge of 0.95%, but then you have Hargreaves Lansdown fee of 0.45% for their fund fees added on top. So you're up around 1.5% if you invest in this one, okay? But not a lot of information here, okay? But basically this fund is going to be investing in private renewable type of projects and infrastructure in and around global energy infrastructure. Myself, I prefer to see a lot more information, a lot more of a track record, a much deeper dive into what's actually being invested in here, because there just isn't enough information on here for me. If you go to the key information document here put out by Schroders, then you do get a little bit more that you can see here. And I've made a few highlights just to show you some of the things. So the fund, by the way, you should always read the key information document on any funds that you're going to invest in, okay? So do that. But as you can see, the fund aims to provide capital growth and income in excess of 10% per annum before fees have been deducted. Right, okay, so 10% before fees. If you take off the 1.5 in the case of this, then yeah, so you're looking at kind of an an 8.5% annualized return. I'm not sure I would tie up my money, have a monthly pricing and a quarterly redemption, as we'll see on this fact sheet, where you can't get your money for potentially 3 months in return for an 8.5% net return. That to me just doesn't sound like a good deal, not something that I'd be investing in. Forgetting about what is actually being invested in terms of global energy and infrastructure, but that's something that's a bit concerning. Here it is for here, subscriptions monthly, so you can buy in monthly, and that's when the fund would actually be priced when you buy in. But the redemptions, like I mentioned, are quarterly. So an 8.5% target return after fees for a quarterly redemption, I'm not sure why I would do that over investing in, say, the S&P 500, FTSE 100, 250, or just global stocks that publish all their data all the time. We have loads of data that we can look at for historical returns as well. But that's my view. What's your view? Let me know in the comments, by the way, on what you think about that. But have a look at this in further detail. But those are some of the highlights that I picked out. Here's the other fund. It's a global private equity fund. This is the fact sheet again on Hargreaves Lansdown. As you can see, very little information in terms of the returns. What there is information is, however, is the ongoing charges. And the net ongoing charge at Hargreaves is 2.6%. Again, that's before the 0.45% fund charge that Hargreaves is going to charge you. So you're looking at 3% in fees. In all honesty, I would not touch this at all. I'm not interested in paying 3% in fees when I could invest in the S&P 500 and pay maybe 0.1%, 0.07% annual fees and get invested in some of the biggest, most proven companies that we have seen in my lifetime, perhaps even longer. That's just me. However, you can make your decision. This isn't advice of any way, shape, or form. That's my opinion on this. Let me know what you think by leaving me a comment in the comment section below. But you can go to Hargreaves and have a look at all of this. The other thing I found is that these funds are actually pretty newly set up. So that's why they don't have much of a track record. There is a minimum investment as well of £10,000 in both funds. So just bear that in mind. It's not for smaller amounts. And I had to answer some questions around my kind of knowledge, sophistication, my net worth, annual salary and things like that before I could really get into all of this as well. So they're clearly limiting it a little bit at this stage anyways. And as we see in the fact sheet or the key information document on this Schroders Capital Global Private Equity Long-Term Asset Fund, again, 5 to 7 year period, in diversified range of private equity investments. The fund aims to have a return in excess of 10% net of fees as well on this case. Subscriptions are monthly, redemptions are quarterly, and the fund may also defer or even suspend redemptions. If they decide for whatever reason there isn't enough liquidity, they can just say no to redemptions for a certain amount of time, I guess. I'm not sure I'd be willing to take that on myself, and I probably wouldn't touch this. And of course, if you wanted to go to Schroders' website directly for a little bit more information, you can do so as well. I'll put the links to all of these pages in the description below, so you can just click on those links and find all of this stuff, like information on the fund manager. And as you can see, it's only really been going for half a year, but it's all there for you in the description if you want to get into more information on all of that stuff. All right, so what do I think about all of this? Well, you probably picked up along the way as we were going through this. I'm not a massive fan, in all honesty. I prefer just to stick with public equities, keeping it simple and investing for the long term in great companies. Of course, there's some concentration risk in things like the S&P 500 right now, but these are amazing companies as well. So for me, I'd be steering clear of any sort of private or alternative investments for my portfolio, at least for the time being. Perhaps if costs came down and returns, we have a greater period of time to track the returns and a bit more transparency, then maybe I would give it a look. So that's my video on investing in public versus private markets. I hope you liked the video. If you did, just click on that like button. It really helps me out. Leave me a comment. I love to hear from you guys and what you think about my videos and the content or anything else that maybe that you'd like to see. Subscribe to my channel if you haven't done so. It's absolutely free. It's an easy way to support me, and I would really appreciate it if you would take the time to hit that subscribe button. If you're curious to see more on what I invest in, I've got a one fund portfolio. I keep it super simple, Warren Buffett style. So I'll put a link to a video I did up on that recently, my one fund portfolio. So Put a link to that one up right there. Just click on that. I'll see you over there. As always, wish you nothing but the best in your savings and investment journey.